Our economy, a complex and ever-evolving entity, is subtly influenced by a fundamental concept we encounter every day: interest. Have you ever pondered why your bank pays you interest on your savings account? Interest affects our everyday transactions, overseas banking, mortgages, and more. By rewarding savers and charging borrowers, it ensures fluent money circulation. The dynamics between savings, loans, and economic stability is intriguing. Not just banks, it infiltrates real estate too. Banks, they resemble your strict parents. They protect your money, but also dictate how you should expend it. High interest is a reward for risk undertaken when lending money. It's a principle embedded in economics and finance. Picture lending like a shared meal. The lender brings their savings to the table, risking potential loss for a chance at gain. This gamble is motivated by high interest, their portion of the pie. Their slice is a just reward for the bravery of lending their hard-earned cash to others. Consider banks. They function as monetary conduits, safeguarding your assets and allocating them to borrowers through high interest rates. The rate differential is the linchpin of their income generation, providing the banks with their source of profit. By depositing your funds in a bank, you are, in essence, indirectly participating in a loaning process, loaning to those who need it, all the while generating a return on your deposit. And return, they pay you interest. Now let's move on to the real estate sector. A central aspect of home buying is the mortgage. Essentially, it's a loan where the buyer borrows money, typically from a bank, to purchase a house. The bank charges interest on this loan, adding to the principal sum. Consequently, the total cost of borrowing exceeds the initial house price. This extra amount is commonly referred to as the interest. High interest rates can have a substantial impact on the economy. When rates rise, borrowing becomes pricier, limiting people's eagerness to use loans. All loans, including those for vehicles or real estate, get impacted. Increased borrowing costs can temper economic growth. The elevated costs deter investments in new ventures, which can tamper the economic pace. Consequently, economic growth slows down as fewer people are willing to take out loans for cars, houses, or new businesses. On the flip side, when interest rates are low, borrowing becomes cheaper. It's akin to a financial incentive, drawing more people to secure loans. Entrepreneurs, car buyers, and home hunters are more inclined to invest. The result, a boost in the economy, growth, but it's a balancing act. Excessive application can upset the equilibrium. If rates persist at a low for an extended period, it can lead to inflation or a general increase in prices. In summary, high interest is the cost of borrowing money. It's a critical tool for financial institutions to generate income. Notably, it plays an important role in economic regulation. High rates can dampen borrowing, thereby slowing economic progress. Conversely, low rates can make borrowing more affordable, thus having the potential to accelerate economic growth. When rates are low, borrowing becomes cheaper, potentially stimulating economic growth. Understanding these concepts is vital for anyone intending to successfully traverse the intricate world of finance. The realms of stock market, real estate, and banking all necessitate a grasp of financial basics. This foundational knowledge empowers informed decision-making and strategic planning. Often, the disparity between success and failure hinges on understanding these principles. So, if you wish to navigate the world of finance, be it investing in stocks, buying a house, or simply saving money in a bank, get ready to delve deeper. Next time you see interest rates, remember they're not just random numbers. They're part of an economic system having a direct impact on the economy's stimulation or tempering. They're not arbitrary, but rather the heartbeat of financial stability. They serve as tools within the fiscal world. They can spark prosperity or trigger recession. The system continually adjusts to maintain economic equilibrium. That's the gist of high interest and economic impact. Stay curious, stay informed, and remember, not everything that goes up is positive.